So our next team, who's going to be the fifth team on our list, is LED and Saad. Please welcome them on stage. Farhan Ali, Saad Hussain Siddiqui, Ruhail, and Ali Hassan.
Hello, hello. Hello, hello. Okay, good afternoon, everyone. But before we dive into graphical representations, statistical measures, allow me to step back and share a scene with you. It's a scenario, consider it please. Imagine that you are at a shore and waves are rolling in, they are rhythmic, gentle, soft, like expected. But ever so often there's a wave that will crash harder than the rest, right? And that is like maybe a flood, very unexpected. So this is a situation that insurers face while pricing risk and premiums. And this is what brings us to this data volatility in insurance pricing. So before moving further, let me introduce you to my teammates. At the lead is Mr. Farhan Ali, and others are Ali Hassan, Saru Siddiqui, and myself, Mohammad Ruhail Jilani. So moving on towards presentation outline, what we'll be discussing throughout this presentation. So we'll be starting with a brief introduction and then a problem statement that what are the impacts and what insurers are so concerned about it. Then analysis and statistical measures like a research, graphical representations, and visualizations, everything we will be discussing in this portion. Then the recommendations that the models we have applied, what model should insurers use to address what challenge. And then at the end, we'll consolidate everything we would have discussed until then in a brief conclusion. Next slide, please. Introduction. Starting with the introduction, catastrophic events like floods, earthquakes, and pandemics. These are the events that occurs every day, right? But when they do, their effect is really severe, and of course, for insurance especially, it is really severe. And because we use historical data to price insurance premiums, we use historical data to price insurance premiums, and the volatility that occurs due to these catastrophic events. But before that, I want to make sure that everyone here knows that how insurers set premiums typically. So this is there are a few steps. We only consider them because time constraint. The first one and the most important one is risk assessment. That what is the risk that a particular holder would claim its insurance. And the next one is calculating expected losses. They must incorporate expected losses, right? And the third one is adding loadings for expenses and profits. The expenses for the whole business environment and the insurers and actuaries who are working in that environment, the salaries, everything. It is that adding loadings for expenses and profit. And the fourth one is adjustment for taxes and regulatory requirements. For regulatory requirements, consider another example. Uh, like for a listed company, it is mandatory 12-month audit, 6-month review, but audit has cost, review has cost. So who's going to pay this cost? Insurance company, of course. And how are they going to do this? Through premiums. So they must incorporate all these factors so that their premiums would be profitable for them. So before we present models to you, let us define the polemic statement through Mr. Fran.
So I am going to tell you about the impacts and the challenges which we will be discussing in this presentation. So the first impact is mispriced products risk insolvency during high claim periods. Overpricing drives away the customers, hence extends the market share. Financial stability falters amid rare extreme events. So now moving towards the core of this presentation, that is challenges. So the challenges are the challenges. How pricing account for unpredictable, catastrophic, or pandemic losses. What methods improve risk prediction with volatile data? How can insurers stay profitable yet competitive in the market? We will be address these all challenges through statistical measures and model analysis. Moving towards Ali Hassan.
Okay, so I'll walk you through two quantitative methods that can be applied in insurance sector to manage the catastrophic risk efficiently. Right now, I'll be in charge of discussing two main methods, Monte Carlo simulation and extreme value theory under the umbrella of peak over threshold model. Firstly, let me introduce you Monte Carlo simulation. It is basically a statistical technique that applies random sampling to estimate the expected outcomes of rare extreme events. What we are doing here is we are using the probability distribution, and here we applied the normal distribution, which is obvious with the shape of this graph, which is bell-shaped. So we have applied the normal distribution with the constants of losses. So अगर हम mainly इस ग्राफ में देखें, हमने इस चीज को predict किया है using the tens of thousands of simulations with the Python कि हम कितना loss extreme events के अंदर face कर सकते हैं, which is encountered between the 3 to 8 CR. ये लॉस हमारे पास पाकिस्तानी करोड़ रुपीस में है, जिसमें हम देख सकते हैं कि ये इनकाउंटर कर रहा है कि हमारे पास मेनली जो लॉसेस अगर हो सकते हैं एक्सट्रीम इवेंट्स में स्ट्रेस टेस्टिंग और सिनेरियो एनालिसिस को देखते हुए वो 3 to 8 CR के बीच में लाई कर रहा है. सेकेंडली हमने जो इसमें से मेन वो निकाले हैं कंक्लूजन वो ये है कि हमारे पास एवरेज एक्सपेक्टेड लॉस अराउंड 4.5 मिलियन पीकेआर है. मैक्स लॉस जो कि हम ऑब्जर्व कर सकते हैं यूजिंग द सिमुलेशंस इज अराउंड 249 मिलियन पीकेआर एंड द 95% ऑफ लॉस इज अराउंड 4.2 मिलियन. प्लीज नेक्स्ट स्लाइड. Okay. Now, as we are discussing the catastrophic events and extreme events, so here is the need of EVT, extreme value theory, with the application of peak over threshold model. यहाँ पे हमने basically in this model we have set the threshold of 35 lakhs. We ये पूरा डाटा जो basically dummy डाटा है, हमें पाकिस्तान के लिए डाटा मिला नहीं था, तो हमने इस पूरे इस सेट आउट का डमी डाटा किया हुआ है. इसमें we have considered that around 35 lakhs is the normal claim which can be achieved. So keeping that in view, we have set the threshold of 35 lakhs. So any value or claim which exceeds the level of 35 lakhs PKR will be incorporated in these bar graphs. So these bar graphs are showing basically the claim amount which is exceeding the level of 35 lakhs, and we have applied the Pareto distribution which is shown by the red lines. इस ये जो distribution है basically ये इन सारे previous values को लेते हुए ये expect कर रही है कि हमारे पास next expected क्या claim आ सकता है on the basis of previous claims. इसमें अगर हम 99.5 वैल्यू एट रिस्क को देखें जो कि 1.29 CR को शो कर रहा है, VAR value at risk are shown by these dotted lines. And we right now, if we look onto the 99.5% expected VAR, is that कि हम 0.05% खाली इस चीज को देख रहे हैं कि हमारे पास जो क्लेम है वो 1.29 CR को एक्सीड करेगा, और हम we are confident about 99.5% that it will be around somewhat around 1.29 CR. Thank you. Saad will continue.
So now let's move to the regression models. Basically, regression models are used for predicting insurance charges. So this helps the insurers to predict to segment the policy holders based on their risk level. So we have taken a dummy data set and we have applied multiple linear regression here. So we have split our data into training and testing. Then we have applied our model. Then our model gives this equation. This equation shows that if we input the values of these variables like age, body mass index, children, and smoker status, so this can help us to predict the insurance charges, the expected insurance charges. This we have done the same with our model. So these are the expected insurance charges. We have compared it with the actual insurance charges. It looks quite similar. So we also have calculated the accuracy of our model, which is quite good, which is 75%. These are some limitations. These are not alternatives. So it has some limitations, like it shows a linear relationship between the input variable and the target variable. And it also has some limitation, like it is very sensitive to outliers and extreme events. To overcome these limitations, we have a suggestion. We have some alternatives basically. So we can use polynomial regression or some machine learning models to overcome these limitations. So moving towards the next model, which is a time series model. Time series model basically are used to predict the future claim amounts basically. So we have applied Sarimax model. We have taken the dummy data set and we have split it into training and testing part. So basically, we have trained our data, trained our model basically, and we have predicted the future value. So we have used the Sarimax model here. Sarimax model is the advanced version of ARIMA model basically. The S in Sarimax is accounts for the seasonality and the X is for the exogenous variable. The exogenous variables are those variables which are affecting our target variable. So Sarimax model also have some parameters like PDQ. So the small PDQ accounts for the lag values, order of differencing, and Q for moving average. And the capital PDQ you are seeing is the order of seasonality, and X is the exogenous variable, which I already told. So we have applied this model and we have forecasted the future values. The red line shows the future claim amounts. So this model also has some limitations, like the Sarimax model require us to manually put the parameters. So in order to overcome this limitation, we have used the auto ARIMA model, which basically selects the best parameters. Then we have applied the Sarimax model after selecting the best parameter through auto ARIMA model. And we have also some limitations, like it is less effective for long-term prediction. So if we want some long-term future forecast, so we can use some machine learning models, some advanced machine learning models like LSTM, FP Profit, or some artificial neural networks.
So now I'm going to tell you about the generalized linear model, shortly called GLMS. So generalized linear models basically predict the risk using historical data, as we clearly seen in the equation as well. So now moving towards the graph. So in the graph, we have assumed a dummy scenario. An insurance company, property insurance company, basically is going to set the premium price for property, especially for the flood-prone areas like DHA phase 8. From the frequency model, it is suggested that there is one flood in 5 years. That means probability is equals to 0.25. From the severity model, it is suggested average loss per claim is equals to 50 lakhs. So by putting these two variables in the GLM equation, we get the solution that expected loss is around 12 lakh 50,000. With the 20% margin, the final premium becomes 15 lakh. We can clearly see this in the graph. So the final premium actually reflects the risk, means which is higher, means that it is higher in coastal areas and lower for safer areas. Basically, GLM sets the fairness and data-driven price in pricing insurance. So, as my member suggested, the limitations of models as well. GLM has also different limitations. So GLM basically assumes linearity. It is poor for rare events and it cannot work on over dispersed data. To overcome these limitations, we have suggested you an alternative model as well, which is gradient boosting machine. It is basically an AI-based model which can take the captures the nonlinear data as well. Next step, please. So now moving towards the Bayesian model. Bayesian model is a model which predicts the risk by using the prior knowledge and the new evidence. It is basically ideal when the data is limited. You can clearly see the Bayes theorem here, which is suggested that posterior probability is equals to evident prior multiplied by likelihood. So now again moving towards the graph. So in this graph also, I have assumed a fake scenario in which a health insurance company is going to set the premium for developing diabetes. Since the customer data is limited, the health insurance company has to use Bayesian model. So from the to set the prior probability, they said that the National Statistic Company suggested that there is 0.1% probability of people having diabetes over the 40 age. Or for the likelihood data, the new customer data suggests that there is 0.6 probability that the customer having diabetes is over 40, overweight, and having a family background having diabetes. So by putting these two variables in the Bayes theorem, we get our updating answer that is 0.3. We can clearly see that the risk get reduced here. So Bayesian model is usually used to predict the uncertain events, but it is ideal when data is limited. So now again moving towards the limitations of the Bayesian model. So Bayesian model cannot work on the large data set. It always work on the small data set. As it is mentioned that it is depends on prior, or prior can be biased. So we have also suggested the alternate here as well. So the alternate here is hierarchical Bayesian model. Basically, it uses group levels priors, like incorporate not only one variable, but it incorporate region, health, age, etc. So now moving towards.
So now we are hovering over one of the most used combination in the industry, GARCH plus EVT. So GARCH is generalized autoregressive conditional heteroscedasticity. What this model does, first consider this chart. It is monthly insurance claim data, and these spikes, they are rare events, maybe pandemic or any catastrophic event, but this data is not relevant. Consider this one. Uh, the most important line here is this dotted line, which is the volatility trend. And we used sample data. Since data is another limitation in this case, so we use sample data with the name of sample insurance data set. And then we used Arch libraries in Python, and we set this GARCH model on it, and it forecasted 37.78% volatility in the coming month. But there is a limitation, like any other model, GARCH also has limitations, but the biggest limitation of GARCH is that it does not forecast extreme expected losses. What GARCH does, you give it low volatility as input, and it will give you an output of low volatility. And if you give a high volatility input, then it will give you a high volatility output. For that, we use extreme value theory. Extreme value theory, it has two forms. One is block maxima, and the other is Power distribution. We use Power distribution because of its accuracy. What it does, Power distribution takes a threshold. All the values above this threshold, they are extreme values, and we use historical data. Any catastrophic event that occurred long ago, we use that data, and this EBT model, it estimated a $700 IMU currency, $7 maximum loss. And look at this, the 99.5% EBT VAR value at risk. This means that 99.5% is the confidence level. Like, we are confident enough that there are 9.5% chances that this value, expected loss, would not exceed the $700. Or maybe 0.5% chances that the severity of the event could be like, it could exceed this value. So this is an equation. This is a loss. You can consider it as a base that we showed previously in presentation, and as a slowing based on watch buffer and the stream loss buffer. By adding those loss, the premium code, it could match a better value. Now recommendations.
So now let's move to the recommendations. We have divided our recommendations into challenge wise. So the first challenge is accounting for unpredictable, catastrophic, or pandemic losses. So in order to incorporate to overcome this challenge, we have proposed three recommendations here. So we can use extreme value theory models to basically capture the rare events and severe losses that can occur during the pandemic. So the second recommendation is insurance company can buy insurance for themselves to transfer the risk of catastrophic events. So the third recommendation is insurers should offer a wide range of products like health insurance, home insurance, and other types of insurance to spread the risk. So the second challenge is improving risk prediction with volatile data. So we have proposed two recommendations here. So we can use the forecasting models like ARIMA model, Sarimax models, and other machine learning models to predict the future claim amounts. So we can also use Monte Carlo simulations to basically test the scenarios, to basically generate the scenarios and test how these conditions to test how मतलब कितनी हमारे पास पॉसिबल आउटकम्स आ सकती हैं और वो हम आउटकम्स अपनी कंपनी पे अप्लाई करें ताकि हम अपनी कंपनी की फाइनेंशियल हेल्थ को देख सकें. So the third challenge is staying profitable and competitive. So we have two recommendations here. We can segment the policy holder based on their risk level, and we can also adopt the dynamic pricing strategy. So over to you, Elias.
Having the time constraints, I'll just shortly explain the case study. This case study is taken from the Society of Actuaries, published in 2024 August. इसमें हम ये देख रहे हैं कि हमारे पास जो कैटास्ट्रोफिक फ्लड आया, जिसकी वजह से over 33 million पाकिस्तानीज ने okay, that's enough. We have seen that over 33 million Pakistanis have suffered due to the flood, due to the suffering of Pakistanis, mainly health और life insurance ने बहुत ज़्यादा sacrifice किया. उसको देखते हुए उन्होंने तीन main जो है वो अपनी recommendations शेयर की इस केस स्टडी के अंदर. नंबर 1 ये थी कि हेल्थ के मॉडल्स लेके क्लाइमेट के मॉडल्स को लेते हुए क्लाइमेट के मॉडल्स को हिस्टोरिकल डेटा के साथ मिलाते हुए एआई एंड मशीन लर्निंग के मॉडल्स इंप्लीमेंट करके ज्यादा बेहतर तरीके से फोरकास्ट करना क्लाइमेट और कैटास्ट्रोफिक इवेंट्स को. सेकेंडली जो था वो ये था कि रीइंश्योरेंस का करना, जिससे मुराद ये कि अपने रिस्क को डाइवर्सिफाई करते हुए दूसरी कंपनीज के साथ पार्टनरशिप कर लेना. और थर्ड मेन पॉइंट ये था कि माइक्रो इंश्योरेंस ऑफर करना ताकि जो लो इनकम ग्रुप है उनको भी टारगेट किया जाए और कंपनी की कॉम्पिटिटिवनेस और जो प्रॉफिटेबलनेस है उसके ऊपर कॉम्प्रोमाइज ना किया जाए. Now let's move towards the conclusion.
And an important statement first: the future of insurance pricing lies in being proactive, not reactive.
So with machine learning models and hybrid models, We can anticipate risk before it strikes.
So we are proud to say we have designed these models with Pakistani in mind.
Thank you.
We are open for questions, sir.
आई थिंक काफी अच्छी प्रेजेंटेशन थी आपने, मतलब फोकस इन हार्मनी विद योर। और मेरा सवाल ये है कि थोड़ा सा आपकी मॉडलिंग जो आपकी एक्सरसाइज है इसको लिंक करना था अपने लास्ट चैलेंज से कि हाउ कैन इंश्योरेंस स्टे प्रॉफिटेबल येट कॉम्पिटिटिव, हाउ आई मीन हाउ दिस मॉडलिंग हेल्प यू इन ओवरकमिंग दिस चैलेंज।
अच्छा देखिए सर, हमने जो मॉडल्स इंप्लीमेंट किए बेसिकली वो रिस्क को टारगेट कर रहे हैं। जब हम रिस्क फैक्टर को और आने वाले क्लेम्स के ऊपर काम करेंगे तो हम इस चीज़ को ओवरकम कर सकते हैं कि हम पहले से रेडी जो सिचुएशन आने वाली है। मसला ही यही है कि हम चीज़ को प्रेडिक्ट नहीं कर पा रहे कि आने वाला सिनेरियो क्या है और उसको किस तरीके से चैलेंज को ओवरकम करना है। तो यूजिंग ऑल दिस मॉडल्स हम बेसिकली एक्सपेक्टेड क्लेम्स को, एक्सपेक्टेड लॉसेस को और आने वाले कैटास्ट्रोफिक इवेंट्स को टारगेट करते हुए इस चीज़ को बेहतर तरीके से अंडरस्टैंड कर सकते हैं कि हम आगे किस तरीके से इन सब चीज़ों को लेके चलें। उसी फ्यूचर को प्रेडिक्ट करने के लिए हमने ये सारे सिमुलेशन और मॉडल्स को अप्लाई किया। तो जब कंपनी अपने रिस्क को प्रॉपर्ली मैनेज करेगी तो ऑब्वियसली अकॉर्डिंगली पॉलिसीज बनाते हुए वो अपने कॉम्पिटिटिवनेस और प्रॉफिटेबल के ऊपर भी काम जरूर करेगी। यही मेन मोटिव।
सर एक्चुअली जो हमारे मॉडल्स हम लोगों ने डिजाइन करे ना, ये हम लोगों ने डिजाइन करे प्रीमियम्स के लिए। कि जो प्रीमियम्स है हम उसको मतलब ऐसा कौन सा ऑप्टिमल प्रीमियम्स को सेट कर सकते हैं कि हमारे जितने भी लॉसेस हैं उन सबको कवर कर ले। जो आप बात कर रहे हैं कि प्रॉफिटेबल किस तरह आ जाए, इसके लिए अलग स्ट्रेटजीज है। जैसे कि यहाँ पे लिखा हुआ है कि सेगमेंट और पर्सनलाइज्ड प्राइसिंग। जिस बंदे का आपको रिस्क ज्यादा लग रहा है उसका प्रीमियम ज्यादा होना चाहिए। जैसे कि हम लोग जैसे कार इंश्योरेंस के अंदर करते हैं कि एक्सीडेंट जिसके ज्यादा होते हैं या किसी के अगर ड्रैगन बहुत ज्यादा हार्श है तो फिर उसके लिए प्रीमियम ज्यादा होते हैं और बाकी लोगों के लिए कम होते हैं। तो इस तरह की सेगमेंटेशन जो डायरेक्ट प्राइसिंग स्ट्रेटजी हम लोग अगर अप्लाई करें तो इंसिडेंस मीट हो सकता है, एड्रेस हो सकता है।
ओके, थैंक यू। आई थिंक
थैंक यू सो मच।
Thank you, everyone. Moving on, our next group is the Infinite Coverage from Karachi University. Sayyid Muhammad Mujtaba Jafri, Sayyid Khizr Ahmed, Sayyid Musa Bukhari.
Assalamualaikum and good afternoon, everyone. My name is Sayyid Musa Bukhari, and these are my teammates Sayyid Khizr Ahmed and Sayyid Muhammad Mustafa Jafri. We are team Infinite Coverage, and today we'll be discussing microinsurance on low-income populations. There are many types of insurances that affect low-income communities. Our model currently focuses on healthcare as it is the biggest concern that low-income people face in Pakistan. Once our model is implemented and it works, then we will shift our focus to other insurances. Let's begin with a question. What happens when someone in a low-income household gets sick? For many of us, we visit clinic, use insurance, or dip into some savings. But for millions of families in low-income communities, the situation is far more fragile. The cost of basic healthcare can force them to delay treatments, borrow money, or sell belongings just to survive. It's a heartbreaking cycle, and globally, this pushes over 100 million people into poverty every year because of out-of-pocket health expenses, and over 90% of them are in low-income communities. That's where microinsurance comes in. Microinsurance is low-cost, simple insurance designed specifically for people with low incomes. It's not about huge payouts. It's about providing a safety net. enough protection to help families manage small everyday risks without falling into financial risks. But as powerful as the idea this sounds, making it work in the real world is the hard part. So what's stopping microinsurance from becoming mainstream? First, there's a lack of data. Insurance needs information, health records, income levels to price risk and set fair premiums. But in low income settings, the data isn't just available or often unreliable. Without it, the insurers are operating in the dark. Then there's fraud with weak IT systems and limited oversight. It's easy to false claims to sift through. And here's the problem: when claim amounts are small, the cost of investigating a claim can even be higher than the claim itself. And lastly, there's high operational costs. Serving remote communities isn't just easy. It takes time, people, and resources to reach them, explain how insurance works, collect payments, and process claims. And when premiums are tiny, those costs can wipe out the business model. So, despite the need, most traditional insurers stay away because the risks feel too low, feel too high, and the returns too low. This brings us to three critical questions that shaped our way of thinking in designing this model. One, how do we keep premiums affordable when we don't have access to reliable customer data? If it gets too high, people can't afford it. Too low, and we risk collapse. Two, how do we reduce costs? How do we reduce costs while still building the trust that is essential in these communities? People are unfamiliar with risk. Some are skeptical. If they don't trust it, they won't buy it even if it's cheap. And three, how can we use technology to our advantage? Can we leverage mobile phones, analytics, and automation to build a solution that scales without losing that human touch? These are tough questions, but they're the kind we need to answer if we want microinsurance to become a real long-term solution rather than a pilot program. There are many barriers at the each of microinsurance process. Now let's walk through what the customer experience really looks like and where it goes wrong. Buying insurance. Many people don't have internet access to comfortable forms. Some of them others don't trust or what they're signing up for. Filling forms, often long, technical, and unfamiliar language. And for someone who's a first-time user, it's intimidating. Getting medical treatments is a barrier. They're expensive and just not available. Paying premiums. Many people don't have steady income or bank accounts. Even if they want to pay, the system doesn't fit with their way of working or living. Filing claims that involves travel, documents, and usually a long wait. Even after all that, they may not be sure they'll actually get paid. And when it's time for the payout, if someone doesn't have a bank account or trust the process, they might never see the money. Or even follow through with a claim. These are the real human barriers, and they show us that the problem isn't the idea of microinsurance, but the way it is delivered. So, if we want this to work, we need to rethink everything from the ground up. We need to make it simpler, scalable, more accessible, and more human.
Well, since my teammate have already discovered the barriers that might occur in accessing a microinsurance, now let's focus on how can we actually eliminate and simplify those barriers. Well, I honestly wish it would be really this much simple that we could just create an app and let the app do all this work. But we have to keep that in mind that here we are talking about the population and the community who belong to low-income families, and especially in Pakistan, we know that low-income families are not very much familiar with technology. So how do you create a system that are not much technologically integrated, yet somehow still effective? That's where Father Plus comes in. What is the Father Plus? Well, Father Plus is a microinsurance model which simplifies the entire microinsurance process from the beginning to the end, and it is especially designed for low-income families. Here's how. Well, for starters, we are introducing the USSD-based enrollment system, which means people can file a claim, enroll, or register by dialing something as simple as *123 or something familiar. Or about premiums? Well, here we have to keep them in mind that we are talking about a population who might not even have a regular income. So here we have to give them a leverage that they can pay premiums according to their own desires. How? Like for example, they can pay premiums weekly, monthly, bi-monthly, so on and so forth. And when someone falls ill in the community, they can just simply visit one of our partner clinics. The clinic can instantly verify the claim using the mobile code, so there's no longer wait and no longer paperwork. From the OPD to healthcare and even hospital stays, everything is covered in it. And from our end, we can use the centralized data encryption method to make the system not only accessible but trustworthy. Our idea and the purpose behind this model is solely based on one thing, which is inclusion. Make sure no one is left behind just because of tech, money, and complexity. Our model Hifazat Plus is not just impactful because of its structure. It's actually the way of connecting humans with humans. How? Like for example, our idea is to market this. Our idea is to market this from the people through their own community. How? For example, we will train the elders, teachers, local shopkeepers, people who are already well known and trusted in the community. Because you just can't expect any person to trust any stranger, especially when it comes to their money. So our idea is to make them aware through their own people, and most importantly, it will give them a sigh of relief, knowing that they are fully protected and covered, especially in the times when they really need it the most, whether it is for one person in the community or for the whole community. Hifazat Plus is here for everyone. Now let's move on. What is the role of technology in microinsurance? Well, simple use of technology in our model Hifazat Plus can make it even more safe and simple. Here's how. For example, as we have discussed already, people can register, enroll, make a claim, file a claim, or even get update on the claim just by using basic SMS and phone call service. And we all know for these services, neither do we need a mobile phone nor do we need internet. So it will remove the technological barrier. And also, we can use the automatic fraud detection method from our end, which will help us in spotting unusual and false claim activity. And when someone files a claim, we can just simply update them through SMS service. Not only it will help us in progressing, it will also build the trust between the insurer and the insured. But here's the main challenge. How you actually convince the people to opt for your model. Like literally you can make the best model in the world, but if people don't want it, it won't work. It is as simple as that. But here's our idea. How do we reach them? How do we convince them? Well, our main goal and idea is to communicate with them emotionally and practically, but in their own language. For example, we ask them, have you ever been at that in your have you ever been at that point in your life where you have to borrow money from someone just for even basic hospital checkup? And when they say yes, we show them how Father Plus can prevent that from ever happening again. It's not just a microinsurance model; it's actually a sigh of relief, especially for the people who really need it the most. Also, we can introduce free covers on many trials. Like for example, we can introduce 50% or 70% coverage, but just for one illness only. Because once they see the actual benefit that they are getting from it, it will most likely that they will be opting it for the long term. Also, we can show them proof through early adopters. Like for example, when even a one person in the community gets benefit from a claim, we make sure that everyone hears their story because people just don't believe people believe people, not paperwork. Another challenge that we thought might occur in our model is how do we actually market our policy without technology? Because we have to cover all the specs. We are considering the fact that low-income families often don't use technology. Hence, they don't use mobile phones or social media. So, how do you actually market it? Well, our idea is to organize community events and free health camps. Like we offer them something helpful first, and then introduce microinsurance in the more familiar environment. Also, we can use the trusted spaces of religious institutions. How? We can use mosques, temples, churches. These are the places where people often go, and we will use their trusted spaces to spread out our message. And lastly, we can also give them free trials. Like for example, if they see the actual benefit that they are getting, especially in the healthcare sector, they will be getting most likely they will be opting it for the long term. We just didn't design this model just for the presentation. It is a practical model and it is a ready to go model.
Good evening. Now that we have explored the design and delivery of microinsurance, let's talk about one of the biggest hurdles, pricing. Traditional actuarial pricing models like GLM rely on large historical datasets, assumptions of statistical distributions like Poisson and Gamma, and advanced modeling skills. But in rural settings, we face quite the opposite, a lack of data, large variability in health claims like OPD visits and major hospitalizations, and a significant risk of mispricing. So, what we needed was a pricing method that's simple, transparent, and which works on smaller data sets. On one hand, as my friend said, if you set the premiums too high, people won't be able to afford them. On the other hand, if we set them too low, we risk insolvency. To solve this, we turn to a modern machine learning technique called conformal prediction. This method doesn't rely on knowing the underlying distribution of the data and gives us a prediction interval instead of a single point estimate. Now, what does that mean? It means that we can say with 90% to 95% confidence that the future total claims will fall within the specific range without needing any assumptions. Now, how does it work? We take historical claims data and then sort them out. Following, we set our confidence level, say 90% or 95%. Then we compute conformity scores and determine a threshold which is similar to our confidence level. And lastly, this gives us a conservative prediction interval, which is essentially a prediction for our premium. Now, I'd like to point out that this demo model that we presented today is a very simplified version of conformal prediction. The idea behind this demo model is to provide reliable confidence intervals and essentially let you know the core idea behind the model. Now, using conformal prediction, we propose a premium of rupees 6,000 annually. This amount is slightly below the 98th percentile cutoff, which makes it both conservative and affordable. It aligns with the average rural household income of about rupees 30,000 per month, according to the Pakistan Bureau of Statistics. It aligns, what we're asking from families is to spend just 2%, actually 1.667% of their annual income for meaningful protection. The number, of course, is rounded off to make it psychologically acceptable and easier to communicate. In short, rupees 6,000 is a fair, defensible, and realistic premium based on data and not guesswork. To conclude, microinsurance is not just a theoretical idea, it's a practical, impactful solution for low-income communities. By using mobile technology, simplifying the process and building trust through community agents, our model Hifazat Plus addresses the core problems when it comes to microinsurance, which is cost, complexity, and credibility. We believe this approach makes microinsurance viable, scalable, and transformative. Hifazat Plus isn't just another product, it's a ready-to-deploy solution that will protect millions from the financial shock of healthcare emergencies. So the next step is not asking how to move along, it's asking how soon can we start. Thank you. Now, if you have any questions, we would be more than delighted to answer them.
Thank you. Good presentation. Simply simple, बड़ी अच्छी सभी. जो प्रीमियम निकाला 6,000 उसमें बेनिफिट क्या मिलेगा, कवरेज क्या मिलेगा?
Sorry, can you repeat the question?
आपने जो बताया 6,000 रुपीस प्रीमियम, तो उसका अगेंस्ट में बेनिफिट क्या है?
That covers OPD visit, medicines, and hospitalizations.
Hospitalization up to what amount?
Well, model we introduced a cap of rupees 30,000 for the start, but of course that is something that can scale to a much higher amount once we find that the model is viable.
Okay, 30,000 rupees limit.
As a start, yeah.
As a start. And 6,000 premium. That's for one person.
Yes, that's for one person.
All right. So OPD included.
Included, yes.
Good presentation. Again, I like the fact that you started attacking the problem and the challenges through a product concept. Statistically, it looks fine, and the model and then the modeling part, I think this is fine. But what I didn't see you talk a lot about, and especially in terms of health setup, health insurance. It's not just about take risk, but also offering services, right? की जो operationalization है health की वो ज़्यादा complicated होती है. उसके ऊपर आपने कोई जिक्र नहीं किया क्योंकि for example अगर उसको hospitalization करनी तो ज़ाहिर है you need to have network hospitals, right? you need to have a lot of networking structure whereby they can actually use those benefits when they need and get them. So you didn't talk a lot about that. You just focused more on price. So उसके ऊपर कोई बात आप जरा clarify.
Yes, of course. We actually did think about that, but I believe that as actuaries, we don't believe that networking with hospitals or NGOs is something that we should concern ourselves with.
That's not the case, actually. Actuaries are not just about numbers. They're not just about coming up with prices and reserves and so on. You also need to make sure that the solution that you're offering is a practical one. It could be implemented. So just a comment from my side. But don't consider yourself to be only focused on one side, and that's just the numbers. As an actuary, you need to have a very good understanding of the business and how the business works. Okay.
Thank you.
I think similar feedback to other people. One thing which I liked was the chronology of the presentation was good. It very well with the solution. And just one comment, as Zain Ibrahim was saying, that I think we also read this quote which is on our office on the 7th floor, and it says that an actuary was only an actuary is not an actuary. So that is what he meant in his feedback, and I would have a similar feedback. Yeah, thank you.
Fair enough, thank you. I just believe that these are things that people qualified such as you would know, but again, as students, that's not something we get to know this or get to talk about that often. But yeah, thank you.
Thank you. Thank you.
I would like to add on to what Umar have said. Okay, and actually used as an actually, so I'm a CEO of a life company, not because I'm an actuary. By the way, I want to make it perfectly clear that I'm not the CEO because I'm an actuary. So इसी तरह से जो हमारे actuarial department में and private sector में जनरली ये practice है जो actuaries होते हैं we expect them to contribute a lot more. तो हमारे जो head of actuarial department से पिछले अभी recently तो किसी और को change किया ही left went to Germany. बट जब कोई प्रोडक्ट बनता था लॉन्च जाता तो वो 3 महीने के बाद सेल्स उनके पास जाकर और नंबर्स निकालकर और उनके साथ बैठ के झगड़ा करता था कि ये प्रोडक्ट बेच क्यों नहीं रहा है. तो सिर्फ उसने तो मसला ही कि उसकी रिस्पॉन्सिबिलिटी सिर्फ ये थी कि मुझे तो प्रोडक्ट बनाना है, प्राइस करना है, उससे बोला गया था बना दो, बट नो यू हैव टू गो बियॉन्ड दैट. तो ये अपने कैरियर के हवाले से, फ्यूचर के हवाले से यू शुड कीप दैट इन माइंड. यस, यू ऑलवेज हैव एन ऑप्शन टू बी दिस स्पेशलिस्ट. Just remain the actuary. No problem with that. But if you want to grow, if you want to expand your horizon, you have to be a lot more than just an actuary. Good presentation again. Chronology was अच्छी थी, चीजें अच्छी थी, identification अच्छी है. Yes, I can see आपकी premium calculation क्या है, market में क्या होता है, practically ज़्यादा आपके पास वो aspect नहीं है. But I think approach is very good.
Thank you.
Okay, so our 7th and second last group is from NED, the Beta Brigade. Fatma, Laiba, Irshad, Mehek, Shoaib, Farah, Fatma, Salim.
Good evening, everyone. This is Laiba Irshad from the Team Beta Brigade, and we are the students of Computational Finance from NED University. And today, our team members, all of us, are going to present you with one of the strategy that tackles one of the most complex parts of actuaries, which is pricing under catastrophes or pandemic uncertain events. So what happens is that whenever the rare events like these strikes, the traditional models for pricing often fails because of the some assumptions which we are going to learn about later in the presentation. And due to which there is a loss of billions of dollars as well as the solvency risk and the fear of starting the unfair premiums. So the strategy that we have come up with isn't simply theoretical. We have used statistical models, mathematical models, as well as the machine learning algorithms. So let's begin by simply understanding the problem that insurers face whenever the market is in chaos. Can you move on to the next slide? Okay. So slide number 2. Problem definition, pricing in chaos. Insurance pricing fails during rare and unpredictable events like cats and pandemics due to extreme data volatility causing unstable models, big financial losses, and difficulty in setting fair yet competitive prices. So what we have seen that catastrophes and pandemics are rare events, but whenever they happen, they cause huge disasters. Let's look onto some of the examples of such events. But the very first one is the COVID-19 pandemic in 2019. So, according to Swiss Re Sigma report 2021, it was estimated that COVID-19 caused a loss of more than $62 billion in insurance claims. Secondly, according to NOAA, it was estimated that the Hurricane Katrina in 2005 led to a loss of more than $82 billion in insurance claims. So we have seen that these events have low frequency but very high severity, due to which the pricing is very complex. Also, one of the key challenges that we see is the data volatility. We do get the data, but that is very sparse, chaotic, and incomplete, and thus affects the way how we estimate our risk and guard our solvency. So traditional models, whenever the catastrophe occurs, either they overprice or they underprice. Whenever they overprice, it leads to the loss of the customers as well as the market share. And if they underprice, it leads to the risk of solvency. For example, according to NAIC 2006, it was reported that 11 US insurers were insolvent post Katrina. So some of the core strategic challenges, the questions that arises is that how are they going to factor these rare events into our pricing? Secondly, we have to say that how can we train our models with the chaotic and incomplete data? And lastly, we have to see that how can we stay competitive as well as solvent in the market at the same time. Now my group member Farah Fatma will further elaborate with the topic. Okay, so now I will explain why traditional pricing model fails during CAT and pandemic events. So we have some assumptions. Number one is predictable event. So it assumes that everything in the world is predictable, but during the CAT and pandemic event, the reality is opposite. Number two, we have independent risk. It suppose that one person problem is doesn't affect another, but during the COVID-19, many people affect at the same time. Number third one is normal loss patterns. So it assumes that future look like the past, but when the new problem arises, so past doesn't help us. And last is data scarcity. So it assumes that they have sufficient data, but in reality, during the CAT and pandemic events, they have not sufficient data for of these type of events. Now we move to the next slide, which is how traditional pricing fails. So first we have generalized linear model. So it is a statistical and traditional model. It works well in a everyday risk, but they often fail during the CAT and pandemic events. Now next are predictability models. So it has combining two sources of information to set up a fair premium, but they break down the emerging and new risk. Third one is loss ratio and exposure based model. So it assumes that future look like the past, but in CAT, past patterns don't repeat. Number fourth one is manual rating and risk classification. So it assumes so these model has fixed pricing rule and they don't adopt and learning from new pattern behavior. And lastly is Monte Carlo simulation. So this model are good, but it is time consuming and require more computational power. Now next we have our turbo strategy. So in order to develop a modern and resilient pricing system, we first needed to solve these four problems. So we had to prepare for the unknown data. So we built a synthetic CAT data generator by using GANs. Next, for forecasting events before they strike, so we introduced a CAT anticipation system using LSTM plus IoT. After that, for the price dynamically with confidence, we introduced actual grade turbo pricing. And in last, to solve to check the solvency in real time, we built flash capital calculator. So all of this thing which we discussed in this slide, we will explain in details by upcoming slide. In upcoming slide. Okay, so now let's move on to the slide number 6, which is the core risk pricing. So basically, in this slide, we are going to discuss and basically compare the two models. The first model is GLM, and the second model is GLM plus XGBoost. So the data that we have used over here was sourced from one of the repository on Kaggle, and we used 10,000 data entries as well as the 6 main features out of the many features that were listed over there. So what we did, we first made a code for GLM, put the data into it and tested and got the results for GLM. Secondly, we made a code for GLM plus XGBoost, put the similar data, got the results for GLM. Now we're going to compare the results of both of the models using some of the key metrics. So the very first one is mean absolute error, MAE, which basically tells us about the average of the model, average error of the model. So the smaller the number is, the more better it is. We can see that the number of GLM plus XGBoost is 481.78 as compared to the number of GLM, which is 507.04. So we can see that the results of GLM plus XGBoost is better than that of GLM. Moreover, let's move on to the next matrix, which is root mean square error, which basically tells us about the magnitude of the error of the model. And similarly, the smaller the number is, the more better it is. And so same is the case with the results of GLM plus XGBoost. And now let's move on to Gini coefficient, which basically tells us about the discrimination of the risk of the model. And the greater the number is, it means the more the risk has been discriminated. So we can see that the number of GLM plus XGBoost is 0.210 as compared to the number of GLM, which is 0.174. So we can see that the number of GLM plus XGBoost is better. Fourthly, here's a statistic, and this basically tells us about the segmentation of the classes of the risk. And the higher the number, the more better it is. So the number of GLM plus XGBoost is 0.150 as compared to the number of GLM, which is 0.122. And lastly, we have the loss ratio stability, which basically tells us about how balanced our model is. And in this specific scenario, we are seeing claim versus the premium. So it basically tells us that if the number is more nearer to 1, the more balanced a model is. So we can say that the number of GLM plus XGBoost is 1.025 as compared to the number 1.033 of GLM. So the number of GLM is a lot more, at least nearer than that of GLM. Now let's move on to the chart. This chart is lift chart comparison. And lift chart comparison basically tells us about how accurate are answers of the model. So on the y-axis, we can see the proportion of actual severity, and on the x-axis, we can see the proportion of population. And the line with the orange is demonstrating GLM plus XGBoost models results, and the line with the blue is just simply telling us about the results of GLM, the model alone. And we can clearly see this is basically the evidence of the results that the model, which is GLM plus XGBoost, is a lot better in capturing the loss severity of the data.
Now let's come up to the dynamic updating. So what we already captured is the risk pricing, the non-linear risk pricing with the XGBoost. The GLM was giving us the base price, and the non-linear risk pricing was captured by the XGBoost. But what we really had to make sure that when CAT and pandemic data comes in, our model doesn't go into frenzy. So for that, we needed a model which will make sure that our prices doesn't spike or undermine doesn't basically overreact. For that, we use the Bayesian credibility. Then we also had to make sure that our pricing is not just accurate, but also it captures in the competitor's pricing. It's competitive enough so that we can stay profitable as compared to our competitor, and we don't lose the customer. So for that, we added in the reinforcement learning, which captures the competitor's prices and basically considers it, learns from it, and adjusts the price dynamically according to it. So, and you can see we have also created a comparison that you can see that the results were significantly better. Currently, we have also given the CAT data or in our the base system that was the GLM and XGBoost. Then we also gave it into our GLM, XGBoost, Bayesian and RL system, and the results, both the errors were there, R square improved, and the loss ratio were nearer to 1.
So now the catastrophe event adjustment. This slide focuses on how we deal
with rare but high impact events like hurricanes and floods. They don't happen often but can cause huge losses. These events are hard to predict because there is only limited historical data. So we solve this problem by using synthetic data generator. This model simulates realistic but unseen disasters guided by actuarial rules to keep them plausible. So what was the outcome of this model is it boosts our data, extend model performance in extreme condition, and it also helps to prepare for unknown risks. So then we compared this baseline versus treatment. As we tested our model to work with only limited historical data versus we gave it our synthetic data, which was generated by GAN and the embedded actuarial dynamic rules. So now next slide. It is baseline versus treatment. So basically, we tried to create this model on our own as on Python, in which we firstly gave it only limited historical data, and the issue we faced was that it overfitted minor patterns and it lacked exposure to extreme loss events. And then we gave it the GAN simulated data, synthetic GAN simulated data of hurricane's path, severity, and flood zone with actuarial rules. So the results were much better. We can see here that our MAE was decreased by 30 points. Similarly, our RMSE also decreased by 30 points. The value of R square was increased by 21%. Also, our TVAR 99.5% was 1.1 million with only limited historical data. But when we gave it centric data, it reached to 1.24 million. That which gave robust pricing buffers. Also, our loss ratio was much closer to break-even. And next one is Flash Capital Calculator. To know exactly how much capital firms need to stay solvent so that there is no over and under protection. So we created our Flash Capital Calculator that use neural networks to estimate VAR and TVAR in order to determine the extra loading insurance firm need to stay solvent. This model rapidly estimates the financial risk learned from historical data, loss data, and climate projection. It replaces Monte Carlo simulation for solvency calculation. So now we compared Monte Carlo versus neural networks. Here, many of the comparisons are here, but we only discuss a few. Number one is the approach. Monte Carlo simulates 1,100 plus losses using probability distribution, while neural network learn pattern from historical data to predict future losses. Second one is runtime. Monte Carlo takes hours and days, while neural network takes only minutes. So, moreover, Monte Carlo needs resimulation with new data, whereas neural network can be updated incrementally with new data. Now, live CATE dashboard. This slide introduces real-time CATE monitoring systems that help ensure predict disaster before they happen and adjust pricing and policies to reduce financial losses. It uses LSTM to forecast even 3 to 7 days in advance, combine IoT sensor data with live satellite feeds, predict location-wise loss exposure. So what will be the outcome of the system is it enables proactive repricing or policy suspension. It also minimizes claims spikes that lead to better profitability.
So let's see whatever we have suggested as a holistic mathematical approach that how exactly are we gonna price our premium. So what we did is that on standard, what we do is like we multiply the expected claim frequency कि कितने claims आ रहे हैं, कितने frequently आ रहे हैं, और उनका amount क्या होगा expected claim severity से, and then we add all the loadings, that is profit margin, the buffers we need to stay solvent, right? We had our own mathematical equation is inspired by that, but we have tried to make it more specific to CAT and dynamic data as well. So what we have done that our base and core risk pricing is given by GLM and XGBoost model. So यहाँ से हमारी base pricing आ रही है. Then we have to factor in the CAT and pandemic data. So for that, we have multiplied the cost CAT loss multiplier. So that is based on time and location. If the data is augmented, is augmented with the real historical data as well as the synthetic data, because we have to make sure that our model is prepared enough. Then now that we have put in put the enough data in the model, we have to make sure that our model doesn't overreact to it. So Bayesian, delta Bayesian is playing the role of that. Then we have to make sure our pricing is competitive, reinforcement learning, and make sure I'm factoring in that. And then we also have to make sure that we are staying solvent. That just in case a disaster strikes, our firm stays solvent. So we kept the capital reserve buffer here, which is basically what we were calculating from fresh capital generated neural net से जो हम where DAVR collect कर रहे थे in order to stay solvent, हमने यहाँ पे वो add किया. Next. Then we also had to see and really compare कि वाकई क्या हमारी जो pricing हमने जो सोचा है कि ये सब होगा, that is actually happening or not. तो हमने क्या किया, हमने ना both data like अभी इसमें normal data भी, अभी normal events का data भी, as well as our cat event data as well as synthetic cat data that we produces, हमने तीनों चीजों के साथ अपने GLM में भी डाला and then हमारे अपने model में भी डाला, and we compared the result. तो उसके RMSE were significantly better. And Gini coefficient improved a lot. AIC और DIC coefficient भी lower हो गए थे और क्योंकि तीनों पे काम कर रहा था, so that's why we came up with के cross validate भी हो रहा है because उसका K-fold का factor भी better आ रहा था. सही, तो that was statistical. फिर हमने देखा कि रेगुलेटरी साइड से भी हमें देखना पड़ेगा क्योंकि इफ यू आर गोइंग टू इम्प्लीमेंट दिस मॉडल रियली इन द सिस्टम, तो हमें ये भी देखना पड़ेगा कि इधर इज इट मीटिंग द सॉल्वेंसी 2 या आईएफआरएस के रिक्वायरमेंट्स और नॉट. तो हम बहुत स्पेसिफिक रिक्वायरमेंट्स में नहीं गए, लेकिन ओवरऑल हमें जो समझ में आया वो ये समझ में आया दैट वी हैव टू स्टे transparent, that our prices should be explainable enough to the government, and we also had to make sure कि हमारे पास solvency रहे, because यूरोप में solvency 2 में वो लोग मांगते हैं कि आपकी फर्म solvent रहनी चाहिए अगर कोई disaster आता है. So for that we make sure कि हमारा model at least solvency को भी factor in करे और हमारी prices explainable भी हो. Although we use machine learning model, लेकिन we also calculated the Sharpe ratios for that ताकि वो explainable भी रहे साथ. So, and we have tried our best to make it as explainable as we could. तो हम ओवरऑल देखते हैं कि इंटरप्रेटेबिलिटी भी हमने कोशिश की है. ऑल्सो डायनामिक प्राइसिंग हर जगह अलाउ नहीं है अभी, लेकिन हम यूरोप के कुछ एरियाज में जहां पे टेस्टिंग अलाउ है हम वहां पे स्टार्ट कर सकते हैं टेस्टिंग के वंस वी सी द रिजल्ट एंड वी कैन अप्लाई इट इन अदर रीजंस एज वेल. Then stress testing normally मैनुअल होती है. असल मॉडल्स में अभी तक मैनुअल जनरली हम ट्रेडिशनली मॉडल मैनुअल हो रही है, लेकिन हमारे मॉडल में ज्ञान से एम्बेडिंग रूल से एंड सिमिलरली न्यूरल नेटवर्क से जो हमारे पास वार और टीपीआर कलेक्ट हो रहा है उससे स्ट्रेस टेस्टिंग ऑलरेडी हो रही है. सही. सिमिलरली गवर्नेंस ऑल्दो थोड़ी सी रिजिड है, हमारा सिस्टम थोड़ा डायनेमिक है, लेकिन हम ऑब्वियसली हम लोग टेस्ट कर सकते हैं क्योंकि हर कोई इसका हल ढूंढ रहा है दैट हाउ कैन वी फैक्टर इन द cat and dynamic event. So that is something we can learn on the long term.
Okay, so because of the time constraint, let's quickly go on to the challenges and how we're going to address them. So the very first one is that whenever we are incorporating a machine learning model into our data, the model that we are creating, the challenge that we face is the black box nature of it. So black box nature is basically that whatever the answer it gives us, we simply cannot take the decision on the basis of that because of lack of explainability. Secondly, if we are incorporating the machine learning, it needs to have a lot of cost of implementation. So to overcome that, we need to actually collaborate with the organizations that can give us the data or simply sign up with the websites that can give us the services on very cheap prices. And to overcome the challenge of black box nature, we can actually do the Sharpe analysis as well as the PDPs. Now, with the synthetic cat data generator, the problem with the GAN is that it can cause more collapse, which means that it can give the same generate the same data over and over again without knowing which region is it in. For example, if I'm in Japan, I would need the data of tsunamis or the floods, or if I'm in any mountainous region, I would need the data of the earthquakes. So what we can do to overcome this is to train our model with the actuarial embedding rules, and also we can mix up the data, the real data and the fake data. So the data that GAN is going to produce is going to follow the same pattern. And lastly, for example, if we are going to incorporate IoT, so whenever we incorporate IoT, it means that we're getting a huge amount of data that needs to be cleaned. So to overcome this, we need to pre-process it well, fill in the gaps in the data, and lastly, we need to backtest it using extreme cases.
Okay, let's come up with the implementation plan. मैं थोड़ा सा time constraint की वजह से मैं बहुत simply बताऊंगी. ओके, आई विल रैप इट अप कि हमें बेसिकली मॉडल को ना फाइन ट्यून करना पड़ेगा, क्योंकि अभी जो हमने मॉडल टेस्ट किया ना वो ऑब्वियसली लिमिटेड डेटा था. वी हैड ओनली 1 वीक टू टेस्ट आवर रिजल्ट्स, तो हमने बहुत लिमिटेड डेटा, तो वी हैड टू फाइन ट्यून बेस्ड ऑन द रीजन एंड रीजन. तो डेटा को फाइन ट्यून करना पड़ेगा. तो मॉडल टेस्टिंग इज वेरी इंपॉर्टेंट. फिर पायलट टेस्टिंग में असल में डेटा को उसमें कुछ रीजंस में हमें टेस्ट करके देखना पड़ेगा, एंड वी हैव टू गो टू द फुल स्केल डेवलपमेंट. सो all in all, you can see the metrics here, but मैं conclude ऐसे करूंगी कि हमारा जो system है वो how is it meeting all the requirements that were there. तो 3 challenges थे कि हमें profitable रहना है और competitive रहना है. तो वो हमारा जो pricing है ना वो इसको make sure कर रहा है, क्योंकि हम कोशिश कर रहे हैं कि ये accurate रहे, तो वो इसको make sure कर रहा है कि ये competitive भी रहे और हम लोग profitable भी रहे. Then the second thing कि हमारी pricing volatile data को कैसे account करेगी. तो हमारा जो cash capital generator मतलब जो डेटा जनरेटर है ना, कैट डेटा जनरेटर, जो हम गैन और एम्बेडेड रूल्स को मिला के कर रहे हैं, तो वो ये वाला काम केटर कर लेगा. और लास्ट में जो हमारा चैलेंज था कि हम कैसे मेक श्योर करेंगे कि हाउ विल वी मेक श्योर ओके. सो स्लैश कैपिटल जनरेटर, हाँ, सॉल्वेंसी. हाउ विल वी मेक श्योर कि सॉल्वेंसी हमारे पास रहेगी, हमारी फर्म सॉल्वेंट रहेगी एंड इट डजंट गो बैंकरप्ट. तो हमारा फ्रेश कैपिटल जनरेटर वो वाला न्यूरल नेट्स वाला ये काम कर रहा है. एंड ऑन द टॉप ऑफ दैट हम प्रोएक्टिव अप्रोच रख रहे हैं. तो हमने लाइव डैशबोर्ड वाला सीन भी डाला है, वाला सिस्टम भी डाला है फॉर दैट कि हम लोग प्रॉफिटेबल हैं. दैट्स व्हाट इट. थैंक यू.
थैंक यू, वेरी गुड. अगर पैशन पे पॉइंट होते तो सबसे ज्यादा आपको मिलते. माशाल्लाह सब बड़े पैशनेट हैं और बड़े जोर शोर से आपने तो मेरे बोल भी अच्छा है. तो मैं एक दो चीजें रिवर्स ऑर्डर में अगर चलते हैं, तो मैंने 2-3 दफा आपकी प्रेजेंटेशन में भी और पीछे भी एक दो बच्चे आए थे, IoT की बात सुनी कि IoT से डेटा. यस, it's a lot of data. I'm just struggling to understand how does it correlate with the tsunami or COVID or जो hurricanes आते हैं. तो IoT से तो even data. I'm talking about weather sensors only की बात कर रही हैं तो अलग बात है, but IoT is a lot more than that.
हाँ, हम लोग बेसिकली हमारा जो मेन मकसद था वो सैटेलाइट्स का जो डेटा होता है ना, और उसका जो सेंसर्स वगैरह का, वेदर सेंसर्स वगैरह का डेटा होता है. एंड फॉर
That's clarified because IoT तो कोई तरह में ऑन ऑफ का स्विच भी है, वो भी आया था. तो वहाँ पर रिलेट बहुत सही. कस्टमर रिटेंशन बेहतर हो रही है. हाउ डिड यू डिटरमाइन दैट? ये कैसे निकाला है? इस कस्टमर रिटेंशन 70% से 82% हो गई तो
हाँ, बेसिकली हमने ना थोड़ा सा जो इंश्योरेंस प्राइसिंग ऑलरेडी जहाँ से हमने डेटा लिया था ना, तो वहाँ वो एक सैंपल डेटा था ऑब्वियसली. तो वहाँ पे भी कुछ उन्होंने रिजल्ट्स दिए हुए थे, और उसमें हमने क्या किया कि हमने ना एक ऐसी अप्रोक्सीमेट लगाया कि मार्केट कितनी बड़ी होगी. सही है. मतलब ये ऑब्वियसली एवरेजेस थे, परफेक्ट नंबर नहीं था, लेकिन एक एवरेज ऑफ द इंडस्ट्री हमने देखा कि मार्केट कितनी बड़ी है. सही है. और हमने ये बेसिकली देखा कि हम अगर हमारी प्राइसिंग इतनी कम हो जाती है तो हम कितना मार्केट को में स्टेबल रह पाएंगे. तो ऐसे बेसिकली.
So all the presentation is based on some data. I think.
Yes.
I would like to understand कि वो data था क्या, मतलब not exact एक नहीं बताएंगे क्या था, लेकिन what was the data size क्या था?
बेसिकली मैंने बताया था कि हमारे पास कैगल का डेटा था, इंश्योरेंस का हमारे पास डेटा था, और 10,000 इसमें लॉस थी. और स्टार्टिंग में पहले हमने शुरू किया था प्राइसिंग से, क्योंकि वो ऑटो इंश्योरेंस से, क्योंकि वो वाला डेटा बहुत आराम से अवेलेबल था. So we first tested on that. लेकिन फिर हमें, क्योंकि obviously कैट इवेंट्स डालने थे, तो हम उसके बाद प्रॉपर्टी भी चले गए थे. सही है. तो मेन जो हमने कोशिश की डालने की वो दैट वाज प्रॉपर्टी वाला डेटा.
इंटरेस्टिंग. पीछे जाएंगे, स्लाइड नंबर 15. So your Gini coefficient is going down. You tell me, yeah.
this is the numbers of the traditional model and this is the driver strategy.
So lower is better.
Is going up. So the nearer it is
So
to
lower is better. You have to. You're selling me pura. It applies only here to this column. Lower is better, higher is worse. ये पूरी रो वाइज है ना, ये नीचे की जो रो है वो लो
नहीं AIC I'm so sorry अगर आप
मैं ये
कॉलम AIC आ रहा है मतलब ये ऊपर नीचे हो रहा है
ठीक है तो जस्ट फ्रॉम प्रेजेंटेशन पॉइंट ये वाला
सही हाँ सर
लॉस सिविरिटी ग्राफ का कोई शुरू भी स्लाइड्स में
Slide 7.
Yes, this one. I would like to understand this better. What do you mean? Proportion of population one पे जाऊँ तो that means 100% of population. 100% the only difference is कि वो curve कैसा है ग्राफ का. So how can you say that XG boost is better than GLM? इससे कैसे पता चलता है?
Basically,
sorry, I'm not a technician, लेकिन how is it better than?
हम ये बेस कर रहे हैं कि जो जितना higher क्लेम सिवियरिटी पकड़ेगा ना मतलब मॉडल प्रिडिक्ट करेगा कितनी मतलब हायर सिवियरिटी जो क्लेम है ना एक्चुअल सिवियरिटी वो जितनी हायर वो देख सकता है या इवैल्यूएट कर सकता है वो मॉडल उतना बेहतर
होगा। Good presentation. Excuse me, good presentation. Yes, I would agree. Quite passionate presentation. And आप लोगों ने बहुत काम किया है डेटा के ऊपर statistically speaking, which is a great thing. क्योंकि आपने कैगल यूज किया है तो most likely आपके पास डेटा भी pretty much perfect होगा in a sense, right? रियल लाइफ में तो ऐसा होता नहीं होता ना। तो अब मुझे ये बताएं कि अगर आपके पास पूरा डेटा ना हो, आपके पास इनकम्प्लीट डेटा हो, आपके पास फ्लॉड डेटा हो, तो फिर आपका मॉडल क्या करेगा?
बेसिकली हमारा जो मॉडल है उसका जो गेन वाला पार्ट है ना वो इसी काम के लिए हमने बनाया है। मतलब बेसिकली सिर्फ गेन को नहीं रखा, हमने क्या किया है, हमने गेन बेसिकली एक मशीन लर्निंग मॉडल है, हमने गेन के साथ एक्चुअल एम्बेडिंग के रूल्स बताए। अब मतलब वीकनेस क्या कह लें या फिर मुश्किल काम कह लें वो है एक्चुअल एम्बेडिंग रूल्स, क्योंकि वो बताएंगे कि गैन तो बस सिंपल ये सिमुलेट करेगा कि हरिकेन पाथ क्या है या सिवियरिटी कितनी हो सकती है या कितना कहाँ पे हरिकेन या फ्लड या जो भी आ सकता है, सही है। तो असल जो बताएंगे ना कि लॉस कितना होगा वो हम आपको बता रहे हैं एक्चुअल एम्बेडिंग रूल, जैसे डैमेज लॉस का रूल होता है या फिर जियोस्पैटियल रूल होता है, तो ये एक्चुअल रूल्स बता रहे हैं। तो मुश्किल काम जो है ना वो एक्चुअल रूल्स को डिजाइन करने का है। मतलब अभी तो हमने बहुत सिंपली 3 रूल्स की बेसिस पे ये डिफाइन कर लिया कि इतना लॉस होगा और गेन से डेटा जनरेट करा दिया, लेकिन असल जब हम जिंदगी में जाएंगे मतलब लाइफ में जाएंगे, इसलिए हमने चैलेंजेस में भी बोला था कि जब हम असल में डेटा प्रोड्यूस करेंगे ना तो हमें फाइन ट्यून करना पड़ेगा कि हम कहाँ मौजूद है। पहला तो कि जैसे अगर जापान में है तो वहां पे जलजला वाली सिचुएशन आएगी तो हमें जलजले के हिसाब से एक्चुअल रूल्स डालने पड़ेंगे ताकि जो ज्ञान, क्योंकि ज्ञान को नहीं पता कि आप कहाँ का डेटा प्रोड्यूस करा रहे हो ना, तो वो डेटा तो आपका मिसिंग वैल्यूज भी प्रोड्यूस कर देगा और वो बहुत अच्छी सारी डिस्ट्रीब्यूशन भी 50 साल की डिस्ट्रीब्यूशन दे देगा आपको। 50 साल में आपके पास 3, 4, 5, 6 जितने भी हरिकेन्स आए वो प्रोड्यूस करके दे देगा, लेकिन उसको नहीं पता कि आप खड़े भी कहाँ हो, मतलब आप जगह क्या है। तो एक्चुअल एम्बेडिंग रूल्स जो है ना उसको लीड करेंगे। अब यहाँ पे हमें एक्सपर्ट ओपिनियन चाहिए होगा, इसीलिए हमने बोला था कि आपको कोलैबोरेशन हर हाल में करनी पड़ेगी। एक तो आईओटी वाली चीज के लिए भी क्योंकि वो तो महंगी होती है, आप हर कोई तो अफोर्ड नहीं कर सकता, और इसके लिए भी कि आपको एक्सपर्ट ओपिनियन चाहिए कि भाई कहाँ हरिकेन मतलब कहाँ आ सकता है, कहाँ जो ज्योग्राफिकली ये चीज पॉसिबल है। गैन तो अपना डेटा प्रोड्यूस करके दे रहा है, लेकिन आया कि फ्लोरिडा में हरिकेन ही आता है, फ्लड्स ही आते हैं या फिर जलजला आ रहा है, मतलब ये वाली चीज। सो दैट वाज आवर मेन मॉडल स्ट्रेटजी।
If you see, practically speaking, you mentioned that you focus on property data. Now, in reality, when you're pricing for CAT, actual claims experience does not matter that much. If you see the global CAT models, what they do is they look at the property where it's located, they look at its construction type, they look at its occupancy type, then they have a set of hypothetical events which they run. and they calculate the mean loss as well as the VAR. So was that approach you also
हाँ,
considered?
क्योंकि जो हमें मेन जो डेटा मिला था ना वो माइकल क्लेम का मिला था, मतलब एनओए में फ्लोरिडा का हरिकेन का डेटा हमें मेन मिला था। उसी से हमने फर्दर कैट का डेटा जनरेट कराया, क्योंकि तो मेन जो बेस थी ना हमारी वो वाली थी, तो उसमें यही वाले आप जो बता रहे हो ना यही टाइप्स दी हुई थी।
So you had exposure policy data, not claims data.
Yes, not claims data, मतलब claims data वो मतलब हमें ये था कि कितना लॉस हुआ।
Okay, so you had claims data.
हाँ, बेसिकली हमने एक नॉर्मल, मतलब मैं सॉरी आपकी मुझे टर्म्स नहीं पता, लेकिन मैं ये बता रही हूँ एक नॉर्मल।
So you had exposure data as well, what were the buildings there, their location, their occupancy, their construction type.
हाँ, क्योंकि जो माइकल क्लेम जो डेटा जो प्रेडिक्ट कर रहा था वो उसकी बेसिस पे कर रहा था, तो वो हमने एनओए की वेबसाइट से निकाले।
Okay, thank you.
इसमें आपकी स्लाइड में डायनामिक अपडेटिंग की थी जी, उसमें आपने कहा है कि फिर एक मॉडल से प्राइस निकली और फिर उसको अपने कॉम्पिटिटर के प्राइस से एडजस्ट कर दिया, तो फिर आपकी जो प्राइस है मॉडल वाली प्राइस नहीं रही ना करना था।
लेकिन हमें ये वाली चीज हम नहीं हटा सकते। ये वाली चीज क्यों नहीं हटा सकते? क्योंकि हमें तो कस्टमर यूज नहीं करने ना। तो आप सही कह रहे हो कि मॉडल की प्राइस नहीं रही तो हम तो इंसॉल्वेंट हो सकते हैं, लेकिन अगर हम ये वाली चीजें हटा देंगे ना तो हम वो नहीं रहेंगे, क्या कहते हैं, कॉम्पिटिटिव नहीं रहेंगे। तो ये इसीलिए ये एक फैक्टर है जिसको इफेक्ट कर रहा है, मतलब ये मतलब ऑब्वियसली हमें मॉडल को फाइन ट्यून ऐसा करना पड़ेगा कि ये बहुत ज्यादा उस पे इतना बहुत ज्यादा सिग्निफिकेंटली हमारी प्राइस को डिफाइन ना कर, लेकिन हमें कहीं ना कहीं तो कंप्यूटर से अपने आप की प्राइसिंग को वो करना पड़ेगा, एडजस्ट करना पड़ेगा। इसका एक हल ये है कि हम यहाँ पे लिमिटेशन लगा दें कि मतलब ये कितना अपने मॉडल को इफेक्ट कर सकते हैं। मैं ये बोल रही हूँ कि 7 दिनों में जो काम हम लोग हो सकता था हमने किया, लेकिन ये रीइंफोर्समेंट लर्निंग को फाइन ट्यून करने वाला काम 7 दिन का नहीं था, ये कम से कम 6 महीने का काम है।
7 दिन की क्यों थी आपके पास?
मतलब बेसिकली जब हमें रिव्यू जो मेंटोर से मिला वो 1 हफ्ता तकरीबन था हमारे पास।
I think it's a really good work. Thank you so much.
Thank you so much, girls. Sadhan, I think you guys did not sleep proudly. Okay, so the last team we have is from NED again, the Value Hunters. Muniba Afzal Khan, Armeen Siddiqui, Minal Azhar, and Muskan Arif.
Assalamualaikum everyone. We are Team Value Hunters and we are here to explore the question that every actuarial, insurer and the underwriters are asking. What they are asking about how can we predict the price. So how can we predict the price while the world keeps changing? So in this case study, we will focus on how we can predict the risk and focus of the data volatility from floods and hurricanes to estimate the major portion areas. Now moving on to the next slide. The year 2024 in a nutshell. The 2024 year is not just a year, it's defining the volatility. The 2024 year is defining all of the catastrophe events and explaining the statistical wake-up call from the global natural disasters. Around $368 billion losses are insured from
are insured from total global economic losses, while only $145 billion losses are insured. So there is a gap of there is a protection gap that will lie in that will continue to grow. Only United States is only accounted for the 78% of global insured losses. So the Hurricane Helen and the tropical cyclone Hurricane Helen is also about the $68 billion losses and making the US the third deadliest hurricane of the century. In total, 336 catastrophe events impact over the more than 14,000 victims. So what it is explaining, the LA fires and world fires and the floods are explaining that these events are getting stronger and the losses are escalating. So we need to move on a better solution. Now moving on to the next slide, major natural events and their impact. We have chosen the most frequent two impacts, wildfires and floods. Wildfires from the last 10 decades, wildfires alone insured losses in about $79 billion. That is almost the 40% of gap of actual economic losses. Coming on to the floods is causing the 5 years on average $320 billion economic losses, on which the 17% of insured losses are there is only 17% of insured losses. What we can say that these losses, as we can see in the losses from wildfires in 2024, in numbers of economic losses might seem lesser than the last years, but there is a volatility that is not decreasing. The volatility is shifting because that there is events are become more unpredictable and more intensifying. So moving on to the next slide, we are mainly focused on network events, but the pandemic threats are also a catastrophe events that we can't ignore. So coming on to these threats, I can give the brief overview that WHO reports 100 major each disease that are coming from more than five diseases coming from each human, from which the 75% of new infections are coming from human animal interaction. These are making the disease spread faster and wider in a rate of 6.7%. As the whole pandemic costs over billion to US $10 trillion range, the cost is huge, so we can't ignore this threat. Moving on to the next slide, risk. So these risks we can't ignore these risks, as these risks are evolving in a global environment. As the increase of 1.5 degrees Celsius, the global warming is expected to come over 1.5 degrees Celsius by 2052 if nothing is changed. Because as the it will directly impact the PNC insurance and the rise that will impact the increase of insurers that will claim more and increase the uncertainty. Now, moving on to the next, in 2050, as the urban living is also increased by 46.5%, also the global travel is also increases by 137.7%. So, what it will impact? It will impact the PNC insurance and infrastructure insurance and risk increases. As these people are traveling more, they will increase the health insurance and life insurance impacting more. As we know, there is a chance of 22 to 28% that there is a likelihood of pandemic occur again in next 10 years. So this is not a theoretical threat, it's an actual threat. Now moving into the next slide. Okay, now we'll have a look at the catastrophes that have shaken the financial backbone of global insurance companies. So here we have plotted the year-on-year changes in the net income of major global insurance players. As you can see, there are major declines in multiple years. For example, in 2017, that was because of number of major hurricanes that occurred. Following in 2018, that was because of Camp Fire, which also affected the insured losses of the insurance companies. Moving towards in the 2022, which was because of Hurricane Ida, which left insurance companies financially crippled. But here is the catch: it's not just headline-making hurricanes. It also, as we see, there are profitability pressures as well. That's because of secondary perils. Now, what are secondary perils? These are the events such as floods, hurricanes, wildfires and the hails, which occur more frequently as over 70% of the losses in 2022 are of secondary perils. Now here the challenge is the traditional models that underestimate secondary perils losses by 40 to 60%. Now that's why, because they are historically seen as small risks, and in today's climate where it is where there is more urban expansion and volatile climate, so these events are more frequent occurring and less unpredictable. Moving forward, now that we have seen how catastrophes and secondary perils event has disrupted profits, now we'll be talking about the core crisis, that's pricing failure. For insurers, pricing isn't just a number, it's a survival strategy. Let's begin with aggregate pricing. In a volatile risk environment, relying on historical averages and traditional models can underestimate future losses, and that's what happened with Lighthouse Property Insurance, where their model actually was incapable of capturing the risk, and because of that, the number of claims piled up, and they couldn't absorb it. Then the industry is also now facing insolvency risk. If premiums don't adequately reflect the underlying exposures, companies are now focused on now focus more to take their capital reserves, which will then further dry up, leading them to collapse. And that was happening with Mercedes in 2018. So it's not just about pricing estimation; it's about model failures and stress and under stress. Even in companies, even if we have in UNH, that is which is a major company with strong fundamentals, that also had felt the heat. Moving forward. Okay. So from an actuary perspective, price risk using history as a guide. But what will happen if the history doesn't repeat itself? So it will disturb. So here we have taken a yearly frequency of earthquakes with a magnitude of greater than 7. So looking at the pattern, it's erratic. We know that there are no trends. So that's non-stationary behavior, as there are major dips and then other spikes as well. So now that's for earthquakes. And the same as for volatility, hurricane intensities, wildfires, pandemic spread rates, and secondary perils as well, which will be further discussed by Armin.
As we have seen, the frequency and severity of the catastrophe are anything but predictable. The volatility of the earthquake occurrences alone highlights the growing complexity of disaster risk. And now comes the real questions. How do we as actuaries quantify the chaos or this risk? The answer to this challenge is the CAT modeling. The CAT modeling is used by the companies to see how much a company bears loss when the natural disaster occurs. Let me break down the CAT modeling into three parts. Let's start with the hazard module. It assesses or estimates the physical properties like wind speed or track, etc. Now coming towards the vulnerability, this is where the actuarial thinking really comes in. Uh, uh, the vulnerability connects the likelihood of a damage to the intensity of a hazard according to the attributes of the asset. For example, how old is the building and what material was used in constructing the building. Then moving towards the financial module, financial module converts the physical damage into the financial loss or economic loss. And lastly, overall CAT modeling calculates the losses which happened when the natural disasters occurred. Now moving on towards let's dive into the categories of NatCat models and industry practices. We have specified the few ones. As we can see, we have a peril type, which is tailored to a specific peril, or we can say catastrophe, that is separate models for hurricanes, earthquakes, and floods. Next is geographic focused. It's a model which is focused to a specific regions, and they use the different geological inputs and codes. For example, a California model uses different geological inputs and codes versus the one that the Italy uses. If we talk about the model resolution, that this model breaks down the risk into the postal codes, neighborhoods, or even the different buildings in the levels. Lastly, for proprietary models, it licenses its model from third-party vendor models, and the company can use its internal model that are used within its organization, and also vendor models to like validate the results or to compare the models. We have also like did research from the NOAA reports, and there were some models that were mentioned there according to these categories that we have mentioned there here. And we have listed few of the models that were mentioned in that report. If we talk about the global forecasting system, it's a global weather forecasting system, and it's a core dynamic model which predicts the atmospheric parameters. Moving towards the second model we have taken is for a specific peril, or you can say hurricanes, a specific peril that is hurricanes, hurricane weather research and forecasting models, and it's a tool used to identify the track or the intensity of the hurricanes. Next is European Center for Medium Range Weather Forecast, and it's used and it is one of the models that is used the most for estimating or for doing research on the atmosphere, etc. Now, lastly, ensemble forecast system. It uses the different simulations or multiple scenarios to estimate the storm intensity and even the uncertainty in the weather. Moving on towards the next slide. Let's talk about the data collection, because the quality of your output depends on the quality of your quality of your output depends on the quality of your inputs. If we talk about and this is where the real complexity begins. When we talk about the risk modeling for the hurricanes, like the AON did the case study for this, and they have like mentioned these. This is where the complexity begins. And if we talk about the exposure data, it tells us the location or the building type or the construction materials or the type or the age of the building. If we move towards the hazard data, this is where the volatility of the data comes in, because we are estimating the wind that is moving towards different direction at different altitudes, the storms or the rainfall intensity across the different time slices, and the most critical part, the to track the hurricanes, which changes within hours. So for this, we have modes that so that we can pull out the data from radars or satellites in real time. Moving on towards a vulnerability module, it examines the building code or the roof type of the building or the flood protection, etc. This is where the key actuarial insight comes, that it's not about how the data is vulnerable, but we have to see how we can quantify the chaos, the risk. Now let's talk about the start. This chart was based on AON's and NOAA's report, and we can see we have listed from 2004 to 2024. We have clearly seen progress in the named storms, but for hurricanes and major hurricanes in 2024, the prediction was overly estimated in terms in terms of the hurricanes and major hurricanes. But that's not because of the bad modeling. But in 2024, there was changes in the weather, like warm seas or fluctuations in the wind patterns, etc. This highlights the main challenge in the actuarial science, because it's not about the data we are inputting in the model, but it's because we can't actually predict it. So this also impacts the risk, the capital and our capital loss. The goal is not about perfect forecast, but it's understanding uncertainty and pricing for range of outcomes. Because actuarial value lies in translating forecast into strategies that holds up when the reality scenarios comes in.
Now, moving on to the next slide, the hidden gaps in catastrophe modeling. So now we are exposing the blind spots that even advanced catastrophe models miss. So the first one is the elephant in the room, model dependency. As actuaries, we rely on vendors' models that dominates the market. But what happens when everyone is using the same when everyone is using the same black boxes and same assumptions, we are getting a close illusion that are in which have some kind of uncertainty. Coming on to the emerging risk of blind spots from cyber events to systematic infrastructure failures, these models are unable to capture these. So what happens when they are too novel and too dynamic that we have to must rethink about the how to quantify risk because when we incorporate the historical capture, there is not the direct connection of that is connected. Now coming on to the crack beneath data quality paradox, how can we expect that the reliable outputs or the claims or the data we are incorporating is complete is incomplete or that is incomplete. So whether the model is perfect or good, it always fails if the fuel is also flawed. So coming on to the climate change, the model breaking reality. So we are still modeling on the basis of past predict the future. So what happens that this shifting baseless and non-stationary weather patterns, the model trained on yesterday climates give us non-stationary broken fundamental values. Now coming on to the next slide. So now we've seen how models estimate a risk, but the main question is how do we turn that risk into a price? That's where science meets strategy. Surely premium starts by estimating expected loss, then adding on the expenses, capital costs, and the margins. But the main challenge comes after that. How do we review our prices based on this data, and how to avoid overcharging or undercharging a customer, and then how to retain those customers while managing the risk? So that's where innovation comes in. Take parametric insurance, for example. Instead of waiting for a claim to be assessed, payouts are triggered automatically. Let's say when a wind surpasses a certain threshold. So it's faster, cleaner, and more efficient. Or the risk-based segmentation, that is charging premium that actually reflects someone's potential risk. That means fairer pricing, reduced adverse selection, and better customer retention. But But as an actuary, we need to think beyond that. We need to think about the solvency. In a world where catastrophe losses are rising and becoming unpredictable, parametric insurance help insurers to limit their liability and strengthen their balance sheet in advance as it provides certainty. Take the example of Hurricane Ian. Swiss Re estimated that an event like that now could cost $60 billion to the insurers, a situation that could jeopardize the industry. For customers, this also means faster recovery, no long claim or assessments, nothing back and forth. But here's the biggest actuarial challenge, and that is of basis risk. That's where actual loss doesn't need the trigger one. So that's where our role becomes more crucial. We need to quantify that risk and price it so that these solutions remain sustainable and fair. So yes, it demands actuary precision to make sure speed doesn't come at a cost of fairness. Another way insurers are managing the risk exposure based segmentation. It sounds simple, change less for a low risk customer to keep the prices affordable and charge high for a high risk exposure customer to reflect the actual loss. But in practice, it's incredibly effective. We found on the report of McKinsey that it shows that you can boost your underwriting profit by 8% by using that approach. And Swiss Re finds out that you can reduce your adverse selection in catastrophe prone regions by 15%. So this isn't just pricing, it's about balancing between price, risk, and profitability. Insurers are also looking beyond that. They are shifting their risk towards the capital markets to add resilience to their insurance system. And that's what's gaining momentum. Insurance-linked securities. So that what it is, that's where capital market steps in, give shoulder to the catastrophe loss, and give
and acts as a shock absorber for the reinsurance. Now that's how it works. If let's say a hurricane hits Florida, so instead of bearing all the losses by insurers, they shift this risk towards the investors, and they do it for the exchange and higher returns. Now, this isn't just theoretical. We have seen that this notional outstanding market, the ILS market, has grown at a CAGR of 7%, and its secondary market has reached $107 billion, and that is as of 2024. But we need to think beyond that, as there are hidden gaps in the catastrophe modeling and etc., and that will further addressed by Mena.
So, but in a world where models can't predict everything, we have to think more holistically. So, what's the path forward? First, we need to rethink how we build and use our models. Instead of relying on a single system, we can take into account multiple approaches, test them openly, and push the boundaries towards the traditional modeling. Next, it's the time to give more attention to secondary parallels, and these events are becoming more frequent, these challenges affect demand in more integrated modeling, as we also need to update models with the real-time data from satellites, sensors, and climate change. It's not enough to reform once a year. Risk is changing constantly, and our tools need to keep up. And finally, true resilience needs collaboration. Public-private partnership can embed loss prevention into insurance products and pricing. So initiatives aren't just about payouts, but about long-term risk reductions as well. Because the future of pricing isn't just actuarial, it's strategic, systematic, and shared. So now what we have seen that modeling catastrophe risk require data that's deep, real-time, and constantly evolving. That price needs to go beyond technical accuracy. It must be strategic and adaptive. And that solution, like parametric insurance and ILS, aren't just financial innovators. They are actual response to global volatility. But behind all of this lies a bigger point. The goal isn't just to predict risk. In an era where uncertainty is accelerating, actuarial science becomes not just useful, but essential. That's the true value we bring, and that's the challenge we are ready to meet. Thank you, everyone.
Good presentation. You laid down the whole cat scenario very well. But I just didn't understand what was your real value proposition. What was the solution that you were eventually arriving at? क्या आप आपके ख्याल में इन सब चीज़ों को सारी बातों को करने के बाद हम बेसिकली वो क्या एक चीज़ है जो आप जनरली इसमें से जो है या ये सारी चीज़ें करनी है वो सोल्यूशन क्या है वो एक पूरा पैकेज है या वो कोई एक पर्टिकुलर एलिमेंट है जिस पे आप फोकस कर रहे हैं?
Okay, so we did our research very much to try to come up with a solution, any model or anything like that. लेकिन हमने यही पढ़ा कि नेट कैट इवेंट्स बहुत स्कैटर्ड है और हर चीज इसकी अलग अलग तरीके से जो है वो डील होती है. आप इसको एज सम अप करके नहीं डील कर सकते. ठीक है, तो एक सोल्यूशन तो इसके लिए पॉसिबल नहीं था. ठीक है, तो व्हाट वी फाइंड द इंडस्ट्री सॉल्यूशंस दैट शी डिस्कस्ड ऑल द कैट मॉडलिंग एंड देन द स्ट्रेटेजिक सॉल्यूशंस फॉर द प्राइसिंग. तो फिर हम इस सजेशन के साथ है कि जो जो उसमें हिडन गैप्स है उनको एड्रेस कर दिया जाए. लाइक डेटा क्वालिटी पैराडॉक्स है कि आप एक तो हिस्टोरिकल डेटा नहीं यूज कर सकते, सेकेंडली आपको रियल टाइम डेटा चाहिए जो कि सैटेलाइट के जरिए ही अवेलेबल होगा. ठीक है, और आई एग्री दैट दिस इज एक्सपेंसिव और इसीलिए लोग सिर्फ वेंडर मॉडल्स और चंद कंपनीज हैं जो मॉडलिंग करती हैं और सब उन्हीं के मॉडल्स को यूज करते हैं. सो दीज आर ऑल द सजेशंस फ्रॉम आवर साइड, बट देयर इज नो पर्टिकुलर सोल्यूशन क्योंकि हमारी रिसर्च के मुताबिक वी कंक्लूडेड दैट देयर इज no possible solution for that. कि एक solution तो हम कभी भी नहीं दे सकते.
I think the good thing was that rather than giving a very complicated numerical solution, you gave the most practical option, which is vendor CAT models, as you mentioned, which are the ones most widely used. So can you name a few vendor CAT models which are currently in use in the insurance world?
The main name that we heard and see was of NOAA, and we also show the graph or their predictions of hurricanes and then the comparison of the actual events that happen. As you can see, the blue dots are the actual events, and this bar candlesticks are the predicted events by the NOA. And this analysis is done by AON in their reports.
Okay, so just to clarify, NOAA is I think, a US agency.
Yes, US
which
agency.
collects information.
Yes.
Aon is a insurance broker.
Yes.
But when you call the vendor CAT models, I think there are three main names. One is, you might have heard of these when you did your research.
Sonata, Swiss Re, and they have 200 models, NetCat, and they have 50 scientists over it.
So there is EQE-CAT, there is RMS, there is AIR. I think these three are the main ones. Swiss Re again is also a reinsurer, so they don't. They might have their own internal models as well. You're right.
Yes, we on their website find out that they have 200 different NetCat models and 50 plus science. That's what actually triggers us that there is nothing possible solution that we give one over here and just say that this is the solution.
And one last comment, if you go on the slide where you were showing the modules of a CAT model. So as far as we were, the one where you show the hazard module, the vulnerability module. So in a standard CAT model, I was thinking there were 4 modules. So it starts with an event module, which has the set of events. Then you have the hazard module, which is the repercussion of those events. Then you have the vulnerability on the property, and then the insured loss.
Yes.
So is that something we have missed here, or there's another interpretation?
No. This is just another interpretation. We do have exposure data.
Okay. Okay, thank you.
Thank you so much, everyone. And with that, we come to the close of an incredible day of learning, competition, and connection. All of you should be proud. You've showcased not just academic knowledge, but real-world thinking. I personally enjoyed all the presentations, but even I have my favorites. But it's obviously up to the judges to decide. So while our results are being compiled, I would like to invite on stage Mr. Naman Rafiq to please come up and hand over a token of thanks to our esteemed judges who took the time out to join us here today. I would like to call upon Mr. Zain Ibrahim. Mr. Syed Nayyar Hussain. Mr. Umar Khan. And Mr. Javed Ahmed. I would also like to welcome on stage our esteemed guests from NED University who joined us today, Mr. Mohammed Amin, and Mr. Faris Rahman. Mr. Naman, if you can come back to announce the results. I have them, by the way. Okay. Okay. So, number third, any guesses? Third position. No guesses. Okay. Can I please also invite Mr. Zain Ibrahim on stage to announce?
प्रोजेक्ट प्रोजेक्ट ऑफ करवा मीटिंग में पीछे पीछे बैठे नक्शा प्रोजेक्ट है जो वन करो तो नहीं ऑफ करवा बस
Okay. Third position. Okay, so it goes to risk flex. Here. Umar, Simil Samad, and Batul Mohammed. A big round of applause, guys. They are winners of 25,000 rupees.
Thank you.
Second position. Any guesses? Okay, I have a hint for you. It's from either NED University or Karachi University. Any guesses, guys? Any guesses? Okay, so second position goes to infinite coverage from Karachi University. They are winners of 50,000 rupees cash. Also, they are being rewarded with free SOA scholarships for P or FM. So yeah, that's congratulations, guys.
Thank you.
Okay. First place. अब तो होने चाहिए guesses. Any guesses? Well, okay, I'll drop one hint. I think passion always wins. So it's BADRI. They are winners of 100,000 rupees and they're also getting free scholarships for P or FM. With us, Fatma, Laiba, Arshad, Mahek Shaukat, and Farah Fatma Salim. Thank you so much. Thank you. Also, for the participants and the winners especially, our traineeship and internship programs are open. So please apply at BADRI, and especially the winners, you will be considered with high priority. So now, as we wrap up ActuMinds